There's a lot of things being thrown out there about mortgage rates, but the bank capitals could go a really long way this year. And it looks like it's going to happen to get mortgage rates just jump lower easily by, let's call it 25 basis points if they take half of that, 45.
Welcome to JP Morgan's Making Sense. I'm Anthony Paolone, and I cover real estate stocks and U.S. equity research. And in today's episode, we're going to talk about the housing market, give a bit of an update on what's been happening in both the for sale as well as the rental housing side of the business. I've got with me today John Sim, who is the head of Securitized Products Research, and that covers the broad mortgage market across U.S. housing. John, thanks for joining us today.
Thanks for having me here.
So let's jump right in. First question, can you give us an overview of the U.S. housing market today? Maybe talk about the supply and demand. I think there's an awareness that we all have about the cost of housing being so high, but give us a state of the market right now.
It's interesting because when we talk about home prices, clearly they've been high. No one can deny that. What's interesting is you just kind of rewind the clock, say over the past 6 years, call it, from 2020 to 2022 is really where we saw this sort of outsized growth with cumulative growth of just about over 35% nationally. But really over the past 3 years, we're just about 10%, just maybe just a little bit over that. So growth has significantly slowed. I guess that's a good thing. It doesn't make things any more affordable because we're not necessarily seeing home prices decline. But with mortgage rates up 300 basis points from 2022, it's not surprising that it's been a little bit of a challenge and a bit of a drag as well. So when we talk about that supply-demand dynamic, we always have to put that mortgage rate in context because what we've really seen is this mushroom of borrowers who were really locked into their homes, right? So this has been a theme that we've talked about over and over again, really. But what's, I think, important to kind of bring the point back up again is that in 2022, when mortgage rates went up 300 basis points to bring us to 6%, we saw about 80% of the market have a mortgage rate at 4% or less. Significant amount, right? So these guys are just locked into their home. And that's really was a lot of the supply constraint. And in some ways, demand constraint too, commensurately. I think what we're talking about supply and demand, where, as you're very well aware of, the demand side has been extremely low. We're pretty much record low on existing home sales. It's been working its way back up higher, but we're not quite to levels that we think where we need to be. But and interestingly, supply has actually started to go back up. 2025 was the first year where we actually saw supply reverse the trend, and it actually was going up relative to previous years, while demand remained low. So you are starting to see some cracks in housing because of that. 2025 only had just over 1% growth. The last time we saw a growth rate that low was 2012. So a long time ago. That kind of paints a reasonable picture of kind of where we are today.
Got it. And maybe just to give listeners some sense here, it's March 2nd as we record this. Where would a borrower, a home buyer going to secure a 30-year mortgage, what would that rate look like today?
Well, it's just under 6%. We were struggling to hit that number. It's actually the first time we've seen that number below 6% since 2022, basically. We did think that we would see more ARM production this year. Interestingly, when we were talking about mortgage rates, one of the calls that we had as kind of a major theme this year is that we would see that ARM share pick up. But a lot of that was on the heels of a Fed rate view that we would be cutting more, right? So if you recall, we started the year with, we thought there'd be another cut. There wasn't. We kind of took that off the table. And so that slowed down our view on where hybrid ARM rates would come into play, because you can get a 5.1 ARM for adjustable rate mortgage, probably around 5.5%. So that can move the needle. So I don't know what we're going to see there, but I do think there's an interesting dynamic to pay attention to with mortgage rates that we've also been talking to around bank capital rules. Because if you remember, Fed Vice Chair Paolone had made a recent announcement. They're basically getting close to releasing the final Basel proposal, and that's bank capital rules, basically, right? So part of that proposal would be to lower the risk weights that banks have on certain mortgages. More broadly, could lower the risk weights to the point where we think that they can offer a mortgage rate to as much as 45 basis points lower than current rates and still have the same return on their portfolio. So that's as much as, so I'm not trying to say you're going to see 45 basis point lower mortgage rates on the bank capital changes, but you do think that's going to give you a little bit more wiggle room. And I think that's something that's not really being heavily talked about. There's a lot of things being thrown out there about mortgage rates, but the bank capitals could go a really long way this year. And it looks like it's going to happen to get mortgage rates just jump lower easily by, let's call it 25 basis points if they take half of that, 45.
Yeah. And so maybe to stay on that, because I think that's pretty interesting. You mentioned 30-year mortgages today just touching inside of 6%. If they go to 5.5, let's say, what happens to activity levels? What happens to demand, do you think? Where is the sweet spot to really see this housing activity pick up?
Yeah, I mean, I think it's every 25 basis points matters, right? You're on a pretty steep slope right now in terms of how much it could help. But I think if you have a 5.5% mortgage rate, you can jump in and debate me on this. You look at existing home sales as much as I do. I think we could break the 4 million number. I think we would be north of 4 million on existing home sales with a 5.5% mortgage rate. And if we got the 4.5%, I think we could be looking at 5 million, right? It's a pretty steep slope because when you get to 4.5%, now you're talking about most of the market is you're not really worried about that borrower who's locked in anymore. And I think you could really go a long way to free up the demand side of the market and really move the needle quite a bit in terms of just bringing activity back to the market.
Yeah, I do want to jump in on some of those things because we do spend a lot of time on that on our side, thinking through the interplay with rental housing and whether folks are moving out to buy homes or not. But before that, what do you think happens to home prices this year in 2026?
Yeah, so in 2026, we expect zero growth nationally. Obviously, there'll be a fair amount of regional variation there. I think part of the challenge in that is you have the supply dynamic is not the same across the country, right? But when you just look at it in an aggregate, we're going to leave it at 0%. If the bank rules come out and we do get mortgage rates back to 5.5% or closer to that number, I would start to push the number higher. I still think we're going to have pretty benign growth because we just had so much growth in the rest of the incomes. Everything else needs to catch up. So we're talking low single digit growth maybe for the year, 2-3%, something in that order of magnitude.
And what are some of the regional variations that you are seeing out there?
Regionally, so no surprise when it comes down to supply first and foremost. And then second order would be whether or not there are challenges around being able to insure property. We've seen a lot of news around natural disasters, higher insurance costs. So with that being said, areas where we see stress, in other words, we think we could see home prices negative this year. We would look at, say, 20 cities, Miami, Florida, Phoenix, Arizona, Dallas, Texas, Denver, Colorado would probably be the top 4 in terms of where we think we'll see negative home prices. And we say negative, not double digit. If anyone is at double digit risk, it would be Miami, Florida. But again, keep in mind that the growth there has been 3 times everywhere else. So giving up a little bit is not really a big deal. And then some of the areas that are a little bit stronger has been Midwest and East Coast, Massachusetts, New York, New Jersey. The supply story that you keep hearing about, the lack of supply, is really resonating. You just don't see inventory. You can go pull up certain zip codes in parts of New Jersey that are close to New York. There's no homes. If you go down to Miami, Florida, and pull up Zillow, search for homes, and you're going to see hundreds, if not thousands, available. So that supply story is really important. Looking at you a little bit, I mean, what do you think about housing policy? I know there's some reforms that could be coming in impacting the housing market. And what do you see in terms of maybe any shift in demand from renting versus home ownership and stuff like that? Because it's been a big topic.
Yeah, it's a good question. So from our side, adding on, you'd brought up kind of this 4 million existing home sales type number, and that's more or less where the housing market has been stuck now for a few years. And so looking at that level of housing activity against the rental market, the short answer is you're not seeing folks leave rentals to go buy homes in any appreciable manner. But what's kind of interesting about that is while you could step back and say, well, if the residents aren't moving out of their rentals to go buy homes, then the landlords would have, in theory, quite a bit of pricing power because folks aren't going anywhere. But that's actually not been quite the case for residents in rentals that renew their leases. Those rents have been going up a decent amount, call it 3% or so. But even that number's come down a little bit over the year. But for residents that move out of their rentals and whereby the landlord's got to go back into the market and find a replacement tenant for those units, those rents are flat to negative pretty much across the board nationally. So when you think about overall rental rate growth in the US, it's been pretty flat for the last year. And it's not necessarily because folks are leaving their rentals to go buy homes, as we just discussed. It really has a lot to do with some rent fatigue because you had a number of years where rents were going up pretty dramatically. You'd started to see residents push back a bit. And real importantly, it's been the supply side where you had a significant amount of new rentals make its way into the market. A lot of new construction that was started in 2021, 2022. You think about large rental communities, they take a few years to build. And so that stuff has basically been delivered in 24 and 25, and it takes a year or so to lease it up. So a lot of that supply has been weighing on the market. And then I'd say the final item is that on the demand side, you have seen job growth slow. It was a notable step down in job formation in the US. And jobs do dictate quite a bit what the landlords can do in terms of pricing power and the ability to move rents. So from where I sit, even though you've not seen a significant amount of move outs to go buy homes for a lot of the reasons you discussed, it doesn't mean that the landlords have had dramatic pricing power. It's been pretty muted in terms of landlord rent growth here.
Yeah, it's interesting. I mean, we look at that obviously as well, just in the commercial mortgage-backed security world, multifamily properties, et cetera. And that, yeah, you haven't seen the rent growth dynamic as strong. I mean, it makes sense. You can only push the needle so much. I think the median income, rent to median income for renters is still like 40%. So how much can you push the envelope on that? Whereas if they were to go buy a home, it's 55, 60%. So clearly they're struggling to go buy, so they're stuck. But that doesn't mean that the homeowner can just jack up rent as well. And part of, I think, a lot of times our interaction has been around, single family versus multifamily and performance. And, what are your thoughts around that dynamic? Is there a big difference in sort of single family versus multifamily, or is it same?
On the rental side, you have seen residents staying longer in single family rentals than you see in a multifamily rental. Now, part of that is just the nature of the resident. You have more families. They're going to stay put a bit longer than perhaps an individual in a multifamily apartment unit. But rent growth for single family rentals has slowed as well. And one of the dynamics there in the last several years, you've seen a pretty big ramp up in what's referred to as build to rent, BTR, which is effectively building individual home rental communities. Oftentimes, these are going to have amenities. They will be clustered. They could be 100, they could be 200, they could be 300 individual homes, and the entire community will be a rental community. And so you're giving customers a full home. So it's a different type of a resident than you would find in, say, a high-rise apartment building. But oftentimes they will have amenities. And there might be a community pool, there might be a park, there might be other types of items for the residents to take advantage of from living there. And you've seen a lot of this construction activity occurring. And so what it's created a bit of is almost, in my view, a bit of this in between folks perhaps living in an apartment building and going out and buying that home. You have this rental home that's in a bit of a rental home community, sort of in the middle. And that supply has actually had some impact on rents. It's kept rents from moving too much on the single family rental side because the supply has really just been coming on over the last couple of years. So we've seen that as a dynamic in the market.
Yeah.
Okay, John, one last question before we wrap up. Anything else on the policy side you're thinking about or focusing on right now? You'd mentioned Basel, but anything else?
Yeah, so Basel is obviously the clear one because I think that's just more immediate and I think we can see a direct impact on mortgage rates. But other things that FHA has put out there is around some changes to the mortgage insurance premiums. They can lower mortgage rates by just reducing the premiums that are charged to the borrower to deliver these loans into the GSEs. So that's one dynamic. There's been a lot of talk about property tax, whether or not you could change the dynamics for, say, people past retirement age. I think that's been thrown out there, right? If you're 65, you shouldn't have to pay property tax anymore. Something along that line that can move the needle with some of the stuck inventory a little bit there. But outside of that, I don't know there's many that I felt would move the needle. There's some maybe even heard it, like the institutional part. Maybe I'll flip it back to you because I know there was a point about, at some point, a discussion around removing institutional investors from the market. Maybe that's a good segue back to you and what thoughts you might have as well on policy.
Yeah, we're paying attention to it quite a bit. So the president did put out the executive order to ban institutional single-family rental purchases. We don't know precisely what that's going to look like, how that will be defined, or whether Congress will even let it go through, but it's certainly something to watch on our side. But very broadly, I do find myself thinking a lot more about the regulatory backdrop for landlords and for rental housing. Affordability is something that's politically top of mind on both sides of the aisle. I don't think it's something that's going away anytime soon. And so, even as we look ahead and think about the rental housing market, it could be a future where there is more potential regulation around that. It used to be something that was very prominent, say in California and New York. There's very well-known rent regulations, but you've seen it cropping up around the country in a lot of different ways. And again, affordability is very top of mind for politicians on both sides of the aisle with their constituencies. So I think the regulatory backdrop is something we're going to be watching very closely and likely for a long time to come. So, John, I think this is going to be a good place for us to wrap it up. So thank you so much for joining and sharing your thoughts with us today.
Thanks for listening to JP Morgan's Making Sense. If you've enjoyed this conversation, share your feedback by leaving a comment or review wherever you listen to podcasts. And be sure to follow our channel so you don't miss an episode. This communication is provided for information purposes only. Please visit www.jpmm.com/research/disclosures for important disclosures. Copyright 2026 JP Morgan Chase & Co. All rights reserved.